Now, Vital Knowledge founder Adam Crisafulli and Wealth Enhancement Group Senior Vice President Nicole Webb. Great to have you both here. And Adam, I will kick it off with you. How much hinges for this market as it starts to flirt with record highs regarding these trade talks?
Yeah, I mean, I think they're obviously very significant, but we're already back to where we were before the trade war really kicked into high gear. So I think not only do we need to have a significant de-escalation between the U.S. and China, but remember, there hasn't been a single trade agreement struck yet. The UK had that. It was a memorandum of understanding, but we're coming up on that 90-day reciprocal tariff suspension deadline in really just over a month from now. And so we have to see more progress on the non-China side of the equation as well. There's a big G7 meeting coming up that starts this coming weekend. I think there's a lot of anticipation that you're going to see at least another kind of memorandum of understanding announced with some other country as well. But there's a lot of anticipation. Markets are, in my opinion, very complacent about the trade risks that are still out there. Keep in mind, we still have a significant tariff burden that the economy is absorbing right now.
Nicole, we keep talking about the wall of worry that stocks have to climb here, but there's also this secular AI growth trade that has reignited in recent weeks. And you can see that with the mega cap tech names leading the rally since those April lows. Do you buy in here or do you sit on your hands and wait for a pullback?
I think there's two really important things. I think first, we have to remember that the market isn't just rallying off of the expectation of being past peak tariffs. It's rallied on real earnings, on the confirmation that CapEx spending is going to continue to happen, and then an economy that just continues to trudge along and refuses to roll over. On the other side of that, to your point, Morgan, we've shifted from a narrative of buying AI in bulk to who can actually deliver and where is the economy of scale on top of AI going to come from. And so this is where you're seeing this divergence in performance across the megs. They're not moving in lockstep anymore. And so you're seeing the benefactors like the Microsofts and the Metas and those like Alphabet that are getting left behind. I think that's where investors have to get really specific if they are deploying cash today.
Adam, we're getting CPI tomorrow morning. Valuations are rich in the market overall. How much of a difference is that going to make?
I think the CPI is really crucial. The May data so far on the growth front has not been great. So, the Fed arguably, I think, has a stronger case to make, for being a little bit more dovish in kind of their forward guidance. So if the CPI is tame, and we've seen the weakness in some of the growth numbers last week, then I definitely think you could see kind of a little bit of a dovish tweak, perhaps, in the forward guidance from the Fed next week at their meeting. So the CPI is going to be important. Then we also have some critical bond auctions as well. I know both of those two events are going to play into how yields perform going forward.
Yeah, and Nicole, you like two retail names, TJX and Home Depot, both up better than 10% over the past 12 months. That TJX doing better than the S&P, up, I think, more like 15+%. S&P's up better than 12. Home Depot trailing the S&P a little, up about 10%. But what does that signify? You're liking retail names about what you expect from the consumer and what investors should expect over the next year?
Yeah, I think when it comes to the consumer and the psyche of the consumer and how that parlays into longer term trends, this is where names like Home Depot and TJ Maxx have longer runways thematically for us, meaning we don't expect that a consumer is going to change their mindset in a short window of time and be ready to buy luxury in high volume demand. Instead, they're going to continue to be more cost conscious as other areas of spending are effectively going to experience a consumption tax through tariffs. And so that offset will happen at places like TJ Maxx. And then the Home Depot trend is just this continuation of a long-term thesis of we are not headed back to mortgage rates at 2.8, 3.5, or even 4 anywhere in the near term. And so the Fed can cut on the front end of the curve as much as they want, but we're just not seeing that movement on the longer end of the curve. And therefore, rates on mortgages likely to stay higher, and we're going to continue to see reinvestment into existing owned homes.